There is a powerful illusion woven into modern retail investing. It feels safe, it feels rational, and precisely because of that, it quietly locks millions of hardworking people into a lifetime of underperformance. That illusion has a name. It's called passive income. You've seen the thumbnails, you've scrolled past forum posts. The promise is always seductive in its simplicity. Buy a stock, hold it forever, and every quarter money appears in your account like clockwork. You imagine freedom, a beach far from deadlines, a quiet cabin with no alarms, bills paid by dividend deposits while your original investment remains untouched or even grows. It feels effortless, it feels safe, it feels like free money. It feels similar to interest from a savings account or rent from a tenant who never calls with problems. And the most comforting belief of all is this: as long as you never sell a share, your capital is still intact. The dividend becomes the reward, the cherry on top. This belief is the foundation of dividend-focused investing, a culture so emotionally attached to payouts that selling shares is treated like a moral failure. But this mindset may be one of the most costly psychological mistakes in modern finance. Here is the uncomfortable truth. Dividends do not create wealth. They are not free money. A dividend is simply a forced partial sale of your own investment. When a company pays a dividend, it isn't rewarding you. It is removing cash from the business and handing it back to you while taxes intercept part of that transfer. Money moves from one pocket to another, with friction in between. This is Mike Invest. If you closely track dividend yields, filter stocks by payout history, or feel uneasy selling shares to cover expenses, stay with me. Today, we dismantle the dividend illusion. We start with a core economic principle known as dividend irrelevance. This theory demonstrates a simple but unsettling reality. A dividend payment does not increase your wealth by a single cent. We'll break down the mechanical price adjustment on the ex-dividend date, expose the tax inefficiency of forced distributions, and show why selling shares is mathematically equivalent and often superior to receiving dividends. To see why the dividend fantasy collapses, emotion has to be removed. A stock is not a magical bond. It's an ownership in a business. So let's simplify the mechanics. Imagine you own a private company with $1 million in cash. You own every share. That business is worth $1 million because the cash belongs to you. Now you decide to pay yourself $100,000. You transfer the cash from the company account to your personal account. Did your wealth increase? No. You now hold $100,000 personally, but the business is worth $900,000. Your net worth is unchanged. Money simply moved locations. This is exactly what happens in public markets. On the ex-dividend date, the stock exchange automatically adjusts the price downward by the dividend amount. There is no debate. The math is immediate. A stock trading at $100 that pays a $2 dividend will not open at $100 the next day. It opens at $98. The company is poorer by $2 per share. You didn't gain value, you received value that already belonged to you. It's no different than withdrawing cash from an ATM. More cash in hand, less value remaining. Yet no one celebrates an ATM withdrawal as income. So why do dividends feel different? Because of mental accounting. We separate capital and income in our minds. Share count feels sacred. Dividends feel harmless. Selling shares feels destructive. Dividends feel protective. That difference is psychological, not mathematical. In a world of zero-commission trades and fractional shares, there's no practical difference between a 4% dividend and selling 4% of your holdings. Both generate the same cash. Both reduce investment value equally. The only difference is emotional comfort. Dividend investors feel safe because their share count stays constant. Growth investors feel uneasy selling shares even when value compounds faster. This leads to an important realization. You don't need companies to manufacture income for you. You can create cash flow from any portfolio at any time. This is known as a self-generated dividend. Dividends remove control. You receive cash whether you need it or not, and in taxable accounts, taxes are triggered immediately. Even reinvested dividends carry a tax bill. Selling shares gives flexibility. You decide when to sell, which shares to sell, and when taxes are paid. That flexibility compounds over decades. Dividend investors voluntarily give this up. They trade efficiency for emotional comfort, and that comfort carries a long-term cost. There's another uncomfortable signal embedded in dividends. When companies are in aggressive growth phases, they reinvest profits. They keep capital inside the business. Large dividend payouts often indicate limited growth opportunities. No expansion worth funding, no innovation worth pursuing. Cash is returned because better uses no longer exist. High yields frequently belong to declining businesses. You're not buying income, you're buying controlled liquidation, a melting ice cube that feels good until it disappears. Never confuse yield with performance. Only total return matters. Price appreciation plus reinvested cash. A stock yielding 10% while losing 5% annually produces 5% total return. A stock yielding 0 while growing 10% wins every time. Retirement is funded by equity, not yield. Cash flow comes from assets, not distributions. Some of the most disciplined capital allocators gladly receive dividends personally, yet refuse to pay them at the corporate level. They understand that retained earnings compound more efficiently than distributed ones. Capital kept inside the engine grows faster. If you trust the logic, trust the behavior. Wealth is built by growing the pie, not slicing it early. To escape the dividend trap, perspective must change. Stop treating dividends as income and start recognizing them as forced sales. Focus on total return. Build growth first and extract cash only when needed. Grow the pie, then decide when to take a slice. Subscribe to Mike Invest and build portfolios on math, not myths.